Have you ever wondered why investors perish over time while speculators lose? It's a curious phenomenon, isn't it? Today, we're diving into the fascinating world of finance to explore the differences between investors and speculators and why their paths often lead to such contrasting outcomes. Investing and speculating, though often used interchangeably, are two very different approaches to increasing one's wealth. An investor, generally speaking, purchases assets with the intention of holding them for a long period. They believe in the intrinsic value of these assets and expect them to gradually appreciate over time. Whether it's shares in a promising startup, a piece of real estate, or a rare collectible, an investor's strategy is rooted in patience and long-term growth. A speculator, on the other hand, is more akin to a gambler. They buy assets with the hope of selling them for a profit in the short term, often riding the waves of market trends and fluctuations. Speculators thrive on volatility, making high-risk, high-reward bets on the future price of an asset. Now, you may ask, why do investors perish over time while speculators lose? The answer lies in the inherent risks and rewards associated with each approach. Investors tend to perish over time, not because they make poor decisions, but because the nature of long-term investing means they're more exposed to systemic risks, market crashes, economic downturns, changes in government policy. All these factors can erode the value of investments over time. Moreover, the long-term nature of investing means that investors often tie up their capital for extended periods, limiting their ability to react to short-term market changes. Speculators, meanwhile, face a different set of challenges. They operate on short-term trends and often leverage their investments, which can lead to substantial losses if the market moves against them. The high-risk nature of speculation also means that they are more likely to experience big losses. In summary, the differences between investors and speculators lie in their strategies, their risk exposure, and the timeframes in which they operate. Investors focus on long-term growth and are thus more exposed to systemic risks over time. Speculators, on the other hand, chase short-term profits and are more likely to suffer substantial losses due to the high-risk nature of their bets. So the next time you ponder over investing or speculating, remember this: both paths come with their own sets of challenges and rewards. Your choice should depend on your risk tolerance, your financial goals, and your ability to weather the storms of the financial market. Whatever path you choose, tread wisely, and remember that in the world of finance, there's no such thing as a sure bet.